If you're not a beneficiary in that trust, you are married to someone who is a beneficiary in that trust.
Yes.
You are not the direct beneficiary. So
Right.
you're not going to be entitled to the benefits of the trust. So if you're saying, I've got children, I want to protect my
them from
assets
those guys.
and protect them from those guys, you can certainly do that through the trust. You're not the only decision maker. As the founder of the trust, and maybe a trustee as well in that trust. There's other trustees that are assisting you in making the decisions.
Yes.
And it's not the beneficiaries. Yes, beneficiaries can also be trustees, but once again, it's not a one-man show. You're not just deciding, I'm going to wake up and go and do this. I'm going to wake up and go and bless someone with, a house or a car.
Yeah. Hey, Red Circle family, welcome back to Brick by Brick, your property power purpose podcast right here on Red Circle Television. I am your host, Dudu, and we are still running on our series with Imvelo Wealth. Balisa is still here with us, and this is our money mindset and property series. And this is our last episode for this series. I'm very sad about it because I love talking building wealth. I love talking, financial readiness, financial wellness, all of those topics I think for me are I'm very passionate about them because everybody should be able to have access to that information and education all the time. Correct. Welcome back, Balisa.
Thank you for having me, Dudu.
We're on our last episode. Now, this episode is going to be speaking specifically to property. So looking at, the practical steps of using property to grow wealth and using it specifically as an asset that can act as a vehicle for investment, but then also long-term investment, which I think mostly property works well when it comes to long-term, in my opinion. But of course, there are many strategies when it comes to property, but we can unpack some of those today. Yeah. So we did touch a little bit on the property aspect of investment in our previous episode, using it as one of the asset classes that, one can invest in and grow wealth. Mm-hmm. I just wanted us to maybe start unpacking that a little bit, looking at what are the different ways that one can, generate an income, for instance, from property? And if property is, in fact, a good investment vehicle, what are some of the risks and the benefits of it as well?
All right. So, Dudu, this is actually your forte.
It is, I know, but
more than it is mine. With that said, I've been exposed a little bit to property, so I will speak from my knowledge of investing in property, but I'll also speak from a financial planning point of view or wealth management point of view in terms of property. So as you said, property is one of the vehicles that people can use to increase their wealth or to generate wealth. It's often not very straightforward because I think we know it very well from we have a house and we live in it. Yeah. And there's lots of other things that we need to take into account. Let's start from the beginning. So before you even start investing in property, there's many things that you need to do because you'll only see the benefits really if you've done things correctly from the beginning. So I think often when we go into property, the physical structures, then you can invest in property in two ways: residential property that you will be living in, or it could be you buy a property but you're going to rent it out. But before you do either of those two things, you need to qualify to buy that property if you're going to buy it using debt. And often we buy property using debt. So right. We take what we often refer to as a bond, right? So we use debt. And so when you're going to use debt, of course, you can have your own money. I mean, the best thing would be invest take something like a unit trust,
Mm-hmm.
have a long-term plan and say, I'm going to save money for the next 5 years and then I will buy a property then. That would be the best way because you've earned interest on that investment and now you're going to, but sometimes, when it comes to investing, especially if you're going to be generating some returns out of that investment, you do borrow money.
That's right.
But now when you borrow money, there's a risk that you're introducing into that into your investment portfolio. And the risk there is that there's a risk of default. So what happens if you default? We don't like to talk about risk more often than not. I mean, in general as people, but it is my job to talk about risk.
Because we don't want to believe that there's risk in anything that we're doing.
Exactly.
Things must just be easy.
Exactly. So it is my job to talk about risk. Yes. And the risk of it is what happens if, for whatever reason, you are unable to repay those monthly amounts that you're supposed to pay back to your financer. And it could be because you've lost your job. Yes. It could be because you don't have a tenant for a month or 2 or 3. How do you make sure that property is still continuing? You're not losing that property because of what has happened now.
Or interest rates increasing, and then therefore affecting your repayments.
Your repayments, and you're not able to afford what you were previously able to afford.
That's right.
But what we also often forget is there's rates and taxes that needs to be paid. There's levies that need to be paid. Are you prepared? And
they're very high sometimes.
And sometimes they're very high. Goodness me, sometimes they're very high.
Very high.
So all of those, you do that analysis in preparation so that you are ready and you're able to then hold your property for a longer period. Because the idea, so on a risk continuum, when we look at property, we look at it as it's more moderately aggressive. It's not too aggressive like you would find in stocks, for instance, and like stocks, you would find in stocks. Yeah. But it's there. It's just between a moderate, so in between as well as aggressive. So we then can say it's a moderately aggressive. Now, what that means is that the risk is high, but also not too high. It's just high. But also, obviously, the returns are also equally related to that. The returns can be potentially very high, right? So because of that, you want to hold it as long as you possibly can. You don't want to sell before you get to your goal. Your goal could be you want to earn an income for the next 10 years from this property, or you will want to earn an income when you get to the 10th year because you would have finished paying it off by then. So the other goal could be you want the capital appreciation from it. How do you get the capital appreciation from it? Is when you then decide to sell it. So you've bought the property, but you will sell it at year 10, as an example. Yes. And obviously what you then want is to find that you bought it for X and you're selling it for Y, which is higher than X. So for you to be able to benefit from it, from that angle, from those 2 points, there has to be a lot that you put in to ensure that you get to that level. Otherwise, you've bought a property. Yes, you've benefited from it if you were living in it because you were living under it. But is it really an asset in your portfolio if you don't end up benefiting from it because of these detours that you get along the way, or you end up having to sell it way lower than what you wanted to get out of it? And so, yes, you certainly can hold property and you can have property as a type of investment, but it's important to take into account all these other things that I've mentioned to ensure that you benefit as you intended out of that property. Yeah.
Yes. Most important one is that one. Understanding that there are other expenses involved in your property buying journey, right? And having, as we had spoken previously, diversified portfolios, it allows you to be able to draw funds, I think, from some of those asset classes for you to be able to maintain that investment as well. We spoke about COVID and the post-COVID era as well, where interest rates were very high and the economy wasn't doing so well. And most people were at the verge of losing their properties. Some were, lost their jobs and were no longer able to upkeep or keep up that investment and had to either let go or look at, downgrading, etc. Now, if you are able to position yourself in such a way where you understand that purchasing at a price that you can in fact afford allows you room for growth. And that's how then the property buying aspect of, growing your wealth, I think, plays a role.
Yeah.
So not everyone should always buy at the price that they can actually afford. That is always my opinion. So when you know that you can afford to buy for 3 million rand, the better idea is to not buy a 3 million rand home. Because then it allows you that room, right? It allows you that room to be able to now maintain all of the other costs that are involved. And then it allows equally for you to be able to benefit from that appreciation of that property, while potentially investing in other properties as well that can be more cash positive, and not just relying on the one that you're living in or the one that you consider your primary residence. So for me, property there's so many different strategies, so many different ways of looking at it. But readiness, I think, is what is critical. So being absolutely ready to invest in property and understanding what that should look like, I think, is key. And having, a financial advisor sort of take you through, having your wealth portfolios in place or other assets in place to sort of cushion you along the way, I think works very well when it comes to investing in property.
Yeah. I actually want to add to the list of things that you're saying you need to be ready with. There's also a fallacy sometimes when it comes to property that that area is booming, that area is doing well.
Yes,
and
let's
it's
buy
a
there.
good time to buy. And you find that you haven't really thoroughly researched in terms of exactly what. And I'll make, I won't be specific, but I've had the experience of buying a property in an area that was busy, that was booming at the time, only to find that it was only booming from a rental income point of view. There was no capital appreciation of property, because what then ended up happening is there was another development next to it, and another development next to it, and another development next to it. And before you know it, the area is really not growing at all from a capital appreciation, because that's what I was looking for at the time, and not necessarily a rental income, because I was living in it. And so I needed the capital appreciation from it, so that when I sell it one day, it's better than what it was.
Yes.
And needless to say, it didn't happen, at least at the time that I needed. So my timelines were a bit of a problem, or my assessment of what I could get out of it was a problem, because I anticipated, I just had the word boom.
Yeah.
And I was, that was it.
That's it. I'm in.
Of course, needless to say, it was way before my time here in the financial services industry. But
we understand. Yeah, it's okay.
But what I'm saying is, it's important to understand when you say it's booming, what exactly
does that
booming?
mean?
What does that mean? And what are you looking for? It is critical to understand what you want to get out of a deal.
Absolutely.
What do you want to get and when? If you are clear on your what and when it comes to goal setting, you will choose the right investment for that goal. But if you just go into it because you've heard so and so say, "Hey, this is
the place to buy,"
and trust me, when it comes to the days that we live in now with social media, and we are seeing Ududu is doing so well in podcast. Now I want to podcast as well, and I don't even know why, but I want to do it now. That is a problem. So I think it's important to understand your own situation.
Sure.
Be clear on what you want to achieve, and then get a professional to help you to analyze it. And your professional should ideally, especially when it comes to properties, I think your professional will not be the same person who's selling you that property.
No.
No.
Well, they're looking for the commission, right? So they're just going to sell it to you so that they can earn that commission.
100%.
But yes, absolutely. Doing the research is absolutely key. So doing that market research and understanding that the area that I'm buying in, what is likely to happen here? And there are other professionals that are involved, I think, in that process that can be very helpful, such as town planners who sort of understand, what is the plan for this specific area on the town planning perspective. And if I buy here, what is likely what is the likely outcome of this particular investment? We've all made that mistake of buying in this suburb because of the name, because more and more people are buying and more people are saying it's the ideal area to buy, etc. But then we don't do the background research. We don't actually understand what we're buying into, and then ultimately we end up not having that ideal outcome at the end of the day.
Yeah.
So with some of the investments that we are buying into and that I have bought as well, the key thing always is to do that analysis, work with the town planner, and know exactly what is going to happen in what time frame. And yes, things can change because government changes its decisions here and there, or sometimes things take a little bit longer to sort of manifest. I'll give an example of, Pretoria, for instance, where I am based. You will find that there are a lot of developments that are coming up in that area. One of which was Menlyn. Menlyn has boomed boom. This area is booming.
Yes.
It's booming. But there are a lot of, I think, individuals who own properties in that area that have held on to the property because they thought, oh, there's a lot of development happening and therefore at some stage I'll be able to sell for X amount. And then what happens? You have all of this development around you, but then your home now is no longer going to be valued at the value that you thought it was going to be.
100%.
And then you end up selling at a loss. So being quick also when it comes to property, I think is very important. Being very quick and making decisions, right off the bat, when you start seeing things sort of happening and moving within that area, don't stay on forever and thinking it's going to, appreciate in some way. Make a decision quickly and move along.
But what allows you to make that quick decision
is
it's some of the plans that you've had in place.
Exactly.
Because you anticipated, right? The whole point is anticipate that these things could happen, and if it happens, what is my plan B?
What is my
move?
move?
It's always that plan B and plan C and plan D that you need to always have, because you never know. Sometimes it's actually you who changes. Sometimes it's not even the government. Sometimes it's not even what's happening around us, but it's you. Your outlook in life could change. Your circumstances could change. You were married and suddenly you are divorced, as an example.
Right.
You were a single parent and now suddenly you're getting married. Or you suddenly have more kids than you thought you would. There's a lot that could happen that would change, or you're changing jobs. So there's a lot that could happen that would want you to, or make you feel that now you want to make certain changes. Are you positioned to make that
prepared?
Quick change? And you can only be positioned to make those quick changes if that happens, I've got. If that, I've got that. And if that, I've got that.
Exactly.
And it's planning. It's all about planning and anticipating and risk management.
The comfort of knowing that you have that cushion somewhere.
Yeah.
It's like, it's
bliss.
Peaceful.
It's a bliss.
It's a bliss. It's so good. It is so good. And I wish more and more of us would understand that, having options is absolutely key. Property is fantastic, and I love it, as I've said. And you can leverage on property in many different ways. I mean, one of the ways that, is refinancing. For instance, I myself have looked at such options, right? Refinancing and taking out that equity and reinvesting it, not going shopping, but reinvesting it, not going to Dubai, but reinvesting it in a vehicle that's going to obviously generate more of an income or capital growth, right?
Correct.
So there are many ways that you can use property that, it can be of benefit to you.
100%.
But having options, I think, is always key.
Yeah.
For me, some of the portfolios that, are in place, whether it's your money markets with the bank or your emergency funds that are waiting for you to go and, grab here and there, are key. Absolutely key, because you never know what's going to happen and when it's going to happen.
Yeah.
And property is one of those things where, as you're saying, it can be quite a risk. So always be prepared for any eventuality when it comes to that investment as well. Some of them are just natural disasters, right?
Yeah.
Sometimes it's just natural disasters and you find yourself, not having a home when you had a home just a minute ago.
Exactly.
Right. And then what do you do next? Right. What else do you have that you can sort of rely on for you to be able to still have a roof over your head? So diversifying, always a key aspect, I think, to investment in every way.
Yeah.
Yeah.
Yeah, no, 100%, 100%. Look, the other thing that I do want to bring in to do while we're talking about property is so obviously I did say to you, you know property more than I do. But mine is really just to plan and really look at risks that are involved. And one of the risks,
how do we protect ourselves?
How do we protect ourselves? How do we protect our families?
Our children.
Our children, because we do these things not only for just, for the sake of it. We're doing it because we want to be taken care of, but also because we want to take care of our loved ones, our families. Right. And so having a life cover, for instance, is very important. It's one of the tools that you need to have when you start investing in property. Why? Because if you're going to be using, for instance, debt to finance that, then along the way, if something happens to you, and I'm using the term life cover, and perhaps the correct or more correct term is to say a risk cover, as we call it in our space, a risk cover which incorporates not just a life cover, but there's also a disability cover, there's also a critical illness cover. Now, I know that it's not very exciting all the time to talk about death, but sometimes you're not dead. You are still alive.
That's right.
But you've got a condition which happens and you didn't plan for it. It happens. You've got a condition which then puts you in a position where you're not able to continue to work the way you thought you would, especially property investors, because property investment is often used as a secondary income vehicle. You've got your primary income vehicle where you are working,
that's right,
and then you use it as an investment vehicle where you're earning an additional income from it,
that's right,
or you are planning, because often, because it takes so long to pay it off, you're not yet earning. You're going to be earning in the future from it. And so while you are still working, you're taking care of a whole lot of other things. One of the things that you should be paying from your income, if you can, or even from the income that you're getting from that property, is a risk cover that will then protect that property in case you pass on, you become disabled, or you get diagnosed with a critical illness. Sometimes, for instance, with a critical illness, you can survive it and you are back on your own 2 feet. But if you didn't put plans in place to make sure that that property is paid, even in a case where you're not able to pay for it, then you could potentially lose it. Or you are gone and now your children have to sell it at a loss because you didn't take a life cover, or you took a life cover but you cancelled it along the way so that it can pay. So it's very, very important once you buy that property, or as you are planning to even buy it, to ensure that you also have a premium to pay for the policy as well. It's part of the costs that you will incur. And also don't be caught off guard when you're applying for a bond and you're busy signing your papers and suddenly there's a paper that talks about a life cover and you're like, why do you now want me to buy a life cover?
Yeah.
And you didn't think of it. Just as you're planning to invest in property and you're going to use debt, ensure that you also have a cover. And one other thing is, even when you're not going to use debt, when you pass on, there are taxes
Involved.
that are involved
Yes.
that you will incur because of that that your estate will incur because of that property, even if it's what was fully paid and all of that. Again, important to factor those in. So it's unfortunate that there's a lot that you need to consider.
Yes.
But it's ideal to rather do that than to take your money and invest it into something that you think it will be X and only to find that you don't get to benefit from it. Nor your children get to benefit from it once you are gone, because you just didn't think of all the, the intricacies that come into owning a property. Yeah.
Absolutely true. I just wanted also for us to unpack very quickly the way in which we can protect our assets, a trust being one of those, right? We had this discussion. It's one of the things that we're also implementing. I wanted to unpack that because I think that's such an important part of the investment journey and the portfolio that many of us don't always consider. And there's so much information out there, about how you structure your trust, how your beneficiaries this and this and that and that. And sometimes it can get pretty confusing, I think. So perhaps take us through in terms of how can we look at protecting our assets in a trust and what are the benefits of that?
Okay. All right. Now, I like that question, Dudu. So I think importantly first is just to take into account that we use trust and sometimes we use unit trust.
Unit trust,
which
okay.
can be very confusing. It happens with my clients.
Please explain it.
Please explain to me, how does a trust work, only to find later that they were talking about a
unit trust all along.
All along, or the other way around. So I'm just going to start by saying there's a difference. It's a huge difference.
Okay.
We spoke about unit trusts earlier when we were talking about investing, just putting your money in emergency funds and things like that. But a unit trust is purely an investment vehicle. It's one of the investment vehicles that you can use when you are investing, or it's a product. We can even call it a product. It's an investment product. In the previous episode, I was trying to say when you are goal setting, for instance, you would goal set and you would use the concept of diversification. And one of the things is you can have a unit trust as, a product or, a diversification tool as an example.
Right.
So I'm bringing it in here in this trust conversation just to say a unit trust, it's an investment vehicle or a product that you can save in short-term, medium-term, long-term, right? It sits often with either insurance companies, investment companies, and nowadays even banks. You can invest from as little as 500 rands. You're basically buying shares, but you're buying it in small bits and pieces, and that's so you're able to buy with 500 rands every month, or you invest at 500 rands every month. So that's a separate product. A trust, on the other hand, it's an estate planning tool.
Right.
It's an estate planning tool. You can put it along the same line as a will. A will and a trust, both of them are estate planning tools that you can use to basically put instructions in place. Now, with a trust, for instance, there's one that you can take while you are still alive. You take it while you're still alive, and it starts working while you're still alive. And then there's a trust that can be set up only upon your passing, based on the instruction that you've put in a will. In a will. So that would be called a testamentary trust, while the other one would be called either an inter vivos trust or a living trust in South Africa. There could be other terms in other, jurisdiction or countries, right? So this one, without really going into too much detail in terms of that, because we would need another 2 hours
Which we don't have.
Which we don't have to have that conversation. But we will mainly just focus on the living trust, particularly because we're talking about property. So to link it up to property, a trust is then a tool that you can use in a way where you would buy your property with it. The ideal way, let alone how it's used, the ideal way is always to have a trust first before you buy your first property, right?
And we often do it the other way. I'm guilty
the
of that.
other way around,
I'm very
right?
guilty of that, yes.
It's like, I often make this silly example to say it's like you buy a phone, but you don't have a SIM card in it. And then you're going to buy a SIM card, and then it's going to cost you a lot of money to put that SIM card into that phone, you know?
Okay.
So the idea is have the trust. Have your house in order. Have your house. Or it's more like you buy the furniture before you have the
house itself, yes.
You know? And then the next thing you know, the house is too small. That furniture doesn't fit. Put it in and all of those things. Yeah. Yes. But let's say here, ideally, you need to have the trust first.
Yes. Start with that structure.
Hold your properties. Then you start, because the trust doesn't have money. So you now need to start putting money into it. As soon as you have the trust, then you want to start putting money into it. So those small investments that you're doing, you could be doing them in the trust. Because what that trust is then going to do is it's going to have a bit of money, and it's going to be able to go and buy under its own registration name. Look at a trust registration name as your ID that you get from Home Affairs. The trust also gets an ID number, a registration number. That means the trust can actually operate. It can operate. Obviously, it operates with, similar to a company, it will operate with people. So in a company, you operate with directors. In a trust, the trust operates through trustees. Trustees are the ones that are controlling the trust and directing where the trust should invest, how the trust should invest, where the trust, how the trust should benefit its beneficiaries, because the trust will have beneficiaries who are people who are going to benefit from the assets that are being held by the trust. So in this case, we then say the property is then bought by the trust. It's owned by the trust. And if it's earning rental income, that rental income is going to be distributed to the beneficiaries of the trust. And when the trust decide to sell that property, the capital appreciation of that property is then going to be distributed to the beneficiaries of the trust. So, and the trust can have a funder and will have a founder as well. So there's a few role players that we can talk about, but importantly, it is a structure that South Africans or anyone can use to their advantage to protect themselves, because only the beneficiaries of the trust will benefit from the benefits of the trust.
Right.
What does that mean? It means that if you're not a beneficiary in that trust, you are married to someone who is a beneficiary in that trust.
Yes.
You are not the direct beneficiary. So you're not going to be entitled to the benefits of the trust. So if you're saying, I've got children, I want to protect them from
those guys
and protect them from those guys, you can certainly do that through the trust. But
very important.
The
very,
very important one is protection from creditors. So you can protect the assets of the trust from yourself, from the beneficiaries who are benefiting, by the way, but you don't want them to benefit and mess up.
Right.
And you can protect the assets of the trust from the creditors as well. You can go and do whatever you want with your own name, with your own ID number, borrow money. And I don't encourage that. I mean, not by any means.
No, we're not encouraging that.
But if it has happened, or if it's happening, you've already, taken so many risks in your life and such that there's an issue. I mean, we take risk every day.
All the time.
We start business.
Everybody has
and sometimes it doesn't work out.
Terrible risk somewhere, yes.
And sometimes it's necessary for us to take risks.
True.
We need to grow the economy. How do we grow economy
100%.
Without taking the risk? So we take the risk. The only thing is we calculate the risk, but we take the risk.
Sure.
We go for it. And so while you're busy taking risk, I want to add to that, it's also a risk that you going to get married, and you get married in commute of property. So that is also a risk on its own as well.
Yeah.
So all those risks, to protect the assets for the benefit of the beneficiaries, you then put those assets in a trust.
Yes.
And that means that they are safe and secured from whatever you want to do. Those assets will then remain and be used the way they were intended. And I think the main thing that makes the trust protected rather, is the fact that you're not the only decision maker. As the founder of the trust, and maybe a trustee as well in that trust. There's other trustees that are assisting you in making the decisions.
Yes.
And it's not the beneficiaries. Yes, beneficiaries can also be trustees, but once again, it's not a one-man show. You're not just deciding, I'm going to wake up and go and do this. I'm going to wake up and go and bless someone with, a house or a car.
If the trustees don't agree, then
if the trustees don't agree, I'm just going to go and invest, even if things are not going to work out and I haven't calculated risk. What it does is it really introduces an accountability.
I was about to say that.
Yes, that you don't usually have by yourself. Because as individuals, if you think about it, we are emotional beings, and I often say
impulsive.
That we are impulsive, we are emotional. Absolutely. We do things because we love you sometimes, and sometimes we hate you.
100%.
Whether it makes sense or not, it doesn't matter. That's just. But
in that moment, it feels right.
It feels right at that moment. We go for shopping when we feel like it, and we want to make ourselves feel good, and we shop. But when your assets are sitting in a trust, emotions aside,
are out.
Things are not done based on emotions.
So ideal. Absolutely.
Are done based on merit. It makes sense. You've checked it with someone else. Yes, you have an idea as a founder, because it's often the case. You have an idea as a founder. I want to go and invest in this business. But you haven't done the proper due diligence.
That's right.
And your co-trustees are there to assist you in thinking differently than you. Take out the emotions. And often in nowadays, there is the master sometimes would insist that there must be an independent trustee. An independent trustee is not even emotionally connected to anything that is happening within the trust. So, for instance,
they can't be manipulated into agreeing in some way, shape, or form.
So, for instance, Imvelo Wealth can be a trustee in your trust, and so Imvelo Wealth is completely independent and thinking logically, not rationally, not emotionally.
Yes.
Just logically, this is how things are supposed to be done. Assessing the risk involved, yes or no, we can go into this investment purely based on merit, not because I like to do, because she
there's money to be made here. What do you mean?
And we're having lunch together and breakfast together, and our kids go to the same school. No,
strict, very strict.
Doesn't work like that.
Yes.
So there is there's definitely a merit to trust. Now, why do people don't always go into trust? And that's key, because there's only a few people that have trust.
Isn't that interesting?
It's very interesting, as beneficial as it is.
Yeah.
And I'm talking even just about the elites. There's lots of elites. There's even legal people that understand trust but would not go into trust. Tax implications, I think, is one of the big deterrents that makes people don't want to go into trust. And there's that fear that I'm going to end up paying way more. But I think sometimes it's misplaced.
Is it a reality? Yes.
Sometimes
I think that's what we need to be able to understand.
Sometimes it's not fully understood in terms of how things are being done there. So, as I often say, consult a professional.
Absolutely.
Don't make a decision and then don't hear from the streets and from your friends and your peers and the circles and at the braai, and then you run away without doing a proper research on it and understanding fully. There is merit to it, so do try and understand it, and if you can, go for it, because it's certainly a tool that I honestly believe pretty much everyone should have.
I agree.
If possible.
I absolutely agree.
Yeah.
Now, because we've done it the other way around,
Mm-hmm.
right? We went and bought properties and started investing, etc. And then now we want to have this trust.
Mm-hmm.
What are some of the implications now in moving those assets into the trust?
Mm-hmm.
Are there costs involved? What does that look like?
Mm-hmm.
Is the process more complicated?
Mm-hmm.
Take us through maybe just to be able to understand that. Because of course we want to correct.
Yeah.
Because we would rather have that.
That's somewhere.
Yes.
That's somewhere.
I'd rather have the trust.
Yeah.
Yeah. So
Yeah.
what are some of those implications
Okay.
there?
All right. So that's a good one. All right. So yes, we are here now. So
Yes.
what do we do?
Unfortunately.
What do we do? So there's two things that we need to separate. One is to open a trust.
Mm-hmm.
I don't want to call it a trust account because just now it's confused with the trust bank account.
Oh, okay.
You know.
Yeah.
So go and apply and get a trust and have that structure
In place.
have the structure in place, and of course you would need to be assisted with that. And then once you have that in place, you've got your trust deeds and all of that. And often when you apply for a trust at the master's office, they just need you to declare that you're going to put an asset in the trust. So the master doesn't want you to just say, I'm opening a trust and just for it to
Just gonna
chill.
be, yeah.
You know, you're opening a trust and that trust must have something.
Yes.
So you're allowed as a South African to donate up to 100,000
Okay.
each year to any entity apart from your spouse. Your spouse, you can donate any amount you want to donate without having to worry about donations tax. But any other entity, which includes a trust, your business, your neighbor, your dog, you know, your friend, your son, your daughter. When you then donate more than 100K a month, a year, then you become liable for tax,
Okay.
which is called donations tax. Now, in a trust, so in practice, often it's the master just expects you to at least donate a pledge that you will do a donation of at least, you know, any amount up to that 100,000.
Okay.
You know, so that's a practical way of looking at it.
Okay.
Now, then once you've got that structure, now we've got this property that we already bought that we want to put in a trust. There's different ways that we can put that property in the trust.
Okay.
And one of the ways is to donate again. But now when we're doing the donations option, remember I mentioned donations tax?
Yes.
So there's the donations tax implications that are coming in. Then there's an option to sell, because you are another entity now. The trust is an entity. You're an entity.
Yeah.
You can sell that property to the trust and have an arrangement of the trust paying you back. There's some tax implications, but not as bad as the one where you're just going to go and pay the donations tax. So as trust specialists, fiduciary specialists, we've got ways.
Yes.
Not to invade,
Yeah.
not to evade, but there's
Tax,
there's strategic ways that you can, you know, structure that agreement such that you still pay the tax, but it's not as heavy as you would think of it. And I guess I'm trying to think of another way now, but I think those are the two main ones. You can either donate or you can sell that asset. Unless, of course, the trust itself has enough money to buy. Because another way, actually, is just for the trust
to just
buy it
assets,
from you. But now, obviously, the trust needs the money.
Of course.
To be able to buy from you. And if you've obviously managed to get the trust, that cash that it will require to buy the property from you, then it would do that. Hence, I was saying earlier, the ideal way is always to have the trust first and then it goes and buy. Because now these ways that I've mentioned, they have cost implications such as the tax that I've mentioned, but there's also another cost implication could be when you're selling a property, if you are selling a property to me, you're going to incur, I'm going to income the one who's incurring the fees, right, for buying that the transfer fees and
transfer duties, their registration, right?
You know, there's lawyers' fees,
that's correct,
conveyancing and all of that. So those fees don't necessarily go away; they are also part and parcel of that arrangement of that
transaction.
transaction. So
Okay.
those fees need to be taken into account
As well.
Yeah.
Okay.
Yeah.
All right.
Yeah.
No, we're going to correct.
It's
So
certainly not.
then do it as soon as possible before you have too many assets that you now need to sell to the trust or for the trust to buy, so that you don't have to incur as much, I suppose.
I like what you're saying, because you're saying before you have too many. In addition, before your asset appreciates too much in value as well.
Because that makes a difference.
That makes a difference.
Right.
You know,
Right.
often when you buy, like, I said in the previous episode, when you buy, you want to buy low. Also, when you put that asset in the trust,
You're selling it now at the value.
It'd be nice if it's still at a lower value, so
Yeah.
that it appreciates
while it's sitting
in the trust. So the ideal is put it in the trust. Is if you've now made that mistake of buying it before you get the trust, put it in the trust as early as you possibly can, while it's still low in terms of value, especially if you are planning on keeping that asset for the long term.
Right.
Yeah.
Perfect. So we're working on that at the moment. Key takeaways. Property, it is a great wealth generating asset,
100%.
in my opinion anyway. A little bit biased.
Well, in mine too.
Yeah. It is great. But of course, buy at the right time, buy at the right price, buy in the right area, understand what you're purchasing as well, so that you can benefit from it long term. Protection, life covers. We've got the trust also in place for you to be able to protect those assets, also to benefit your children and their children, etc., for generational protection.
Yeah.
Very key. Thank you so much, Balisa, because for me, it's important for all of us to get to understand that while it's attractive to invest in property and to have investments, it's important to know also what some of the risks are and how you can protect yourself from those risks.
100%. And I think with any investment, you find that each type of investment that you're going to get into, it's got its own nuances that you need to take into account. So even with property, it's got its own, as well as attractive as it is. And by the way, I'm also a big fan. I'm also a big fan of your business as well, and what you're doing here, educating people about property investment, but understand the nuances of the investments that you're going to get into. Even if it's property, it's not black and white. There's lots of gray areas.
A lot.
Understand that, consult professionals when you need to know which professionals to consult, not just any professional, of course. And when you're good and ready, go for it.
Go for it. And that's why we're here. That's why Brick by Brick is here. We want to bring that information. We want to share education. We want to bring on the experts that people can consult and consider on their investment journeys as well. And thank you so much for accepting to be part of this series. I know you're a very busy lady. So busy. So sometimes it's hard to hold you down, but I try. I really try.
I know.
Because you do what you do so well, which is why you're very busy as well. And you're trusted in the industry. And that's why I'm even, working with you, and you're my wealth manager as well. So thank you for taking the time to be part of this series. It means a whole lot to me, and being a part of the podcast as well. And I hope that we will continue to engage. And if there are questions, if Red Circle family does want to have, more information, or have perhaps more people come on to explain different aspects of, financial planning, etc., I'm sure we can always tap back into Imvelo Wealth and bring someone on to come and elaborate on any other topic.
100%. Do 100%.
Amazing. Thank
100%.
you. Well, there you have it, Red Circle family. Thank you for joining us for this episode. We hope that it has been informative, educational, and I hope that this series is going to help you to begin making those financial decisions and really setting yourself up for success financially in your future, as well as your children and, their generation after that. All right. So maybe let's just tell the audience how they can find Imvelo Wealth. Where do they go? What are your social media platform handles, the websites, etc., so that they know that they get. We'll also put it in the description box so that to make it easy, but just let them know, where can they find Imvelo Wealth?
Okay. So Imvelo Wealth has a website, www.imvelowealth.co.za. We are also available on all social media platforms. So Instagram @Imvelo Wealth, LinkedIn, Imvelo Wealth Solutions, especially if you are confused, because there's other Imvelos out there. So Imvelo Wealth Solutions on LinkedIn, on X at Imvelo Wealth, and on TikTok, Imvelo Wealth, and Facebook at Imvelo Wealth. So pretty much all the social medias at Imvelo Wealth. You can also contact me on my direct one, which is ntaba.balesa.
Okay. We'll have
That's
it in
my
the description box as well.
That's my personal one. But I think the easiest ones would be the Imvelo Wealth.
The Imvelo Wealth. And then I'm sure on the website, the links will probably also be there to all of the different platforms.
The links are there, and there's contact details,
yes,
which you can also get through to us via WhatsApp if you have to use the WhatsApp. So the contact numbers are there, and we can WhatsApp the contact numbers, or you can call the contact numbers.
Okay, perfect. There you have it. I know how to get a hold of you, and now they do too.
Of course.
Thank you so much, Balesa. Thank you for being part of this series. So thank you for joining us, and we'll see you in our next episode. Oh, and this is the last one, I think, for December. So that means we're not going to be broadcasting any episodes, I think, for the holidays. So this is my Merry Christmas to you, and Happy New Year and all of the rest. And we'll see you in the new year. Bye, Red Circle family. Thank you so much.
Bye.